Welcome to RBC's Markets in Motion podcast, recorded March 2nd, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know: we run through 5 things we're thinking about regarding recent developments in the Middle East from a stock market perspective. Then we wrap up with a few things we're watching in terms of general stats to help us know when the recent risk-off mood in stocks may have played out. If you'd like to hear more, here's another 5 minutes. Let's start with 5 thoughts on the Middle East. Number 1, we think the U.S. equity market was already starting to digest the escalation in the region coming into the weekend. The S&P 500 has moved sideways so far in early 26, reined in by a fairly long list of concerns: AI fears, private market concerns, an underwhelming reporting season, extended valuations, and an increase in a few different flavors of geopolitical risk. On the latter, it's worth noting that expectations the U.S. would strike Iran in betting markets were fairly elevated throughout early 2026, though expectations that the Supreme Leader would be out in betting markets were lower. Both the choppiness in the S&P this year and the outperformance of the energy sector were reflecting heightened geopolitical risk to some degree. Number 2, historically, elevated geopolitical uncertainty isn't good for S&P 500 PE multiples broadly, which have already been under pressure since August. In recent years, we've seen some deterioration in S&P 500 median PEs when uncertainty regarding national security has spiked. We saw this in spring 2025 around the Liberation Day tariffs, 1Q22 around Russia's invasion of Ukraine, and in the first quarter of 2020, which was COVID. This is something we also saw in early 2003 as the U.S. was preparing to invade Iraq. Number 3, elevated geopolitical uncertainty and risk has become a feature of the post-COVID environment, but could weigh on sentiment. On the corporate side, references to geopolitics on public company earnings calls have been extremely high in recent years relative to their pre-COVID history. Companies have often emphasized their ability to manage through challenges, and we tend to see them describing the geopolitical backdrop as evolving, dynamic, unpredictable, and fluid. On Middle East tensions specifically, support for oil prices from energy companies and boosted demand for hedging from financial companies were also discussed. We're eager to see what companies say about the weekend's developments in coming days, but for now expect the managed through messaging to persist. We will also be monitoring how these latest developments in U.S. foreign policy impact consumer confidence, which has been stabilizing around extremely low levels, as well as public opinion polls where voter approval on foreign policy has been quite low. Number 4, we'd be careful paying too much attention to historical studies that suggest you always want to buy stocks on bad geopolitical news. These studies are floating around the street. We've done our own work to look at how stocks have performed following geopolitical conflicts involving Russia or the Middle East since 2000. We sorted them into 2 categories: bigger wars and more limited conflicts. Our work suggests that the bulls on the issue are technically correct, but also that this idea is really driven by trends following more limited conflicts. In the 3 major wars we examined, stocks were down 12 months later in 2 of them. Stocks were also down in the 12-month period ahead of 2 of the 3 major wars, including the one that had the best track record in the aftermath, the Second Gulf War of the early 2000s. And number 5, when it comes to stocks, it may mostly come down to oil. There has been an inverse correlation of minus 40% between the S&P and oil prices since COVID. But in our view, the key issue is not whether there is a short-term spike in oil prices. What's more relevant to stocks, in our opinion, is whether a sustained impact to oil is seen, which is what we think would have more of a potential to damage confidence at various levels. And now let's wrap up with a few general quantitative things we're watching to help us gauge when the risk-off phase we've started to see in stocks may be over. First is sentiment. In the latest update, net bulls on the weekly AAII survey fell to minus 6.6% on the weekly data point and 0.5% on the 4-week average. The weekly data point is close, but not quite back to 1 standard deviation below the long-term average, last seen in November, helping confirm a bottom in the S&P 500 after a quick 5% drawdown. If another garden variety 5 to 10% drawdown is underway, which is something we have been anticipating this year, or something even shallower, this may tell us when the sentiment unwind has run its course. If a deeper pullback is starting, a return to 2 standard deviations below the average will likely be an important milestone. Second, we've seen some deterioration within the U.S. equity category of flows for U.S. large cap, passive institutional flows, and blend flows. While some of the other flow categories we track have pointed to rotation from growth to value, trends in these categories are pointing to more of a de-risking phenomenon underway. And finally, valuations. The market cap weighted S&P 500 next 12 months PE remains up around 25.5 times. well above its long-term average of 18.5, which helped mark the low in the index in the fall of 2022. The Russell 2000 FY2 PE is also something we're keeping an eye on. At 16.9 times, it's not too far below the November 2024 highs. Last spring, after the Liberation Day tariffs, that Russell PE fell just below 13 times, into a range that's often seen during recessions and similar to the lows of the fall of 2022 and 2023. And at the industry level, the PE of the capital markets industry, which is made up of investment banks, retail trading and crypto-related names, and asset managers, including alternatives with private markets exposure, has seen its valuations improve significantly, but is still sitting near long-term averages as a whole on both absolute and relative PE. All of these will be key to watch if stocks continue to weaken from here. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.